Well, first, I do believe that the second round of securities purchases was effective. We saw that first in the financial markets. The way monetary policy always works is by easing financial conditions, and we saw increases in stock prices. We saw reduced spreads in credit markets. We saw reduced volatility. We saw all the changes in financial markets, and quite significant changes, that one would expect if one was doing an ordinary easing of policy via a reduced federal funds rate. And indeed, we saw the same types of financial market responses in the first round, which began in March of 2009. So we were able to get the financial easing that we were trying to get. We did get very significant easing from this program. You would expect, based on decades of experience, that easing financial conditions would lead to better economic conditions. And I think the evidence is consistent with that as well. As I discussed in more detail in my Humphrey Hawkins testimony in the beginning of March, between late August, when I first indicated that the Federal Reserve was seriously considering this additional step, and early this year, not only the Federal Reserve, but many outside forecasters upgraded their forecasts, and we saw strengthening labor market conditions, higher rates of payroll job creation, et cetera. Now, the conclusion, therefore, that the second round of securities purchases was ineffective could only be validated if one thought that this step was a panacea, that it was going to solve all the problems and return us to full employment overnight. We were very clear from the beginning that while we thought this was an important step and that it was at an important time when we were all worried about a double dip and we were worried about deflation, we were very clear that this was not going to be a panacea, that it was only going to turn the economy in the right direction. And indeed, we published some analytics which gave job creation numbers which were significant, but not certainly not enough to completely solve the enormous jobs problem that we have. So again, relative to what we expected and anticipated, I think the program was successful. Why not do more? Again, this was similar to the question I received earlier. The trade-offs are getting less attractive at this point. Inflation has gotten higher. Inflation expectations are a bit higher. It's not clear that we can get substantial improvements in payrolls without some additional inflation risk. And in my view, if we're going to have success in creating a long-run, sustainable recovery with lots of job growth, we've got to keep inflation under control. So we've got to look at both of those, both parts of the mandate as we choose policy.